Let's start with a definition and an explanation of what accounting is. The nature and function of accounting can be defined as the orderly and systematic recording of the monetary values of financial transactions of a business. It is used to report results and to provide financial information as a basis for decision making. There are three accounting processes, which include identifying, recording, and communicating. Identifying involves identifying the economic and financial transactions, recording of those transactions so as to provide a permanent history of the business's financial activities, and then the communicating of that recorded information to the interested users by means of accounting reports or financial statements. The nature of financial accounting is used to convey the financial situation of an enterprise. This means that it is therefore essential that the recipient of this information is able to understand it. This is done by using words and figures in the financial reports, and therefore accounting is a language which is used to convey financial information to users. The different forms of ownership include sole trader or proprietor, closed corporation, company, partnership, and non-profit organizations. So the end goal of accounting is obviously to generate useful reports. So the next question is, who uses these reports? The users of financial information include the investors, who are the owners or shareholders with a financial interest in their businesses, creditors, who are the lenders of money, merchandise, and services. They also have a financial interest. The employees of a business, who are interested in job security, wage negotiations, and predictions for future employment. The government, who are always interested in our taxes. They also use the information for statistical purposes and for indicators of macroeconomic planning. The management also uses this information in order to plan and set new goals for future economic growth. Accounting is broken up into two fields, namely financial accounting and management accounting. Let's have a look at some of the main differences between the two. Financial accounting is mainly concerned with the recording of transactions and preparing financial statements regarding the entity as a whole. This is done using the generally accepted accounting practices, which ensures comparability of financial statements between businesses, whereas management accounting is used to provide financial information for a specific purpose. This is then used by management for decision-making and to assist management in reaching their financial goals. The nature of accounting theory includes 6 fundamental accounting principles, namely accrual, consistency, prudence, materiality, matching, and realizations. So what does this all mean? The accrual principle states that a transaction must be recorded in the financial period in which it occurs, whether or not the cash has been received or paid. So in other words, if I was a business owner and I sold some goods on the 30th of the month, and I only received payment from the customer on the 5th of the next month, the transaction would be recorded on the 30th of the previous month, namely when the transaction occurred. The principle of consistency says that once a method has been chosen, it must be maintained. If, however, the said policy is changed, it must be reflected in the financial statements of the business. The principle of prudence says that when there is uncertainty about the value of an element or event, always use the most unfavorable effect on the business. The principle of materiality says that all material transactions should be recorded separately in the financial statements. Immaterial transactions must be aggregated. So this means that we separate the material transactions from the immaterial transactions. In other words, material transactions meaning something of substantial or relatively large importance, like buying a building, and immaterial transactions, which would be, for example, buying a pen or some stationery. The principle of matching, which refers to the double entry system, and says that expenses that create an income must be recorded in the same financial period. And lastly, the principle of realization, which says that an income, expense, or transaction should be brought into account once it is relatively certain that the collectability or payability of that transaction is certain.